I keep hearing private credit offers better yields than bonds. Should I put some of my portfolio into a business development company or interval fund? And what's the catch? There's a $30 trillion market that, until recently, only pension funds and endowments could access. It's been quietly outperforming bonds for years. And now, for the first time, you can buy into it through your regular brokerage account. But here's the thing nobody tells you. The two main ways retail investors are accessing it right now work very differently, and picking the wrong one for your situation could leave you stuck when you need your money most. Private credit is simply lending that happens outside the traditional banking system. When a mid-sized company needs $50 million to expand, they used to go to a bank. Increasingly, they go to private credit funds instead, because private funds move faster, offer more flexible terms, and don't carry the regulatory constraints banks do. In exchange for that flexibility, the borrower pays a higher interest rate. That extra yield is what makes private credit attractive. While investment-grade corporate bonds are currently yielding around 5%, private credit strategies have historically delivered 8 to 12%. That gap is real. The question is what you're giving up to get it. As a retail investor, you have two main doors into this market. Door 1, business development companies, or BDCs. These trade on the stock exchange just like any other stock. You can buy them in your brokerage account today, sell them tomorrow, and check the price in real time. Popular ones include Ares Capital, Blue Owl Capital, and FSKKR. They're required by law to distribute at least 90% of their income, so dividend yields are often 8 to 11%. The catch, because they trade publicly, their price moves with market sentiment, not just the underlying loan performance. In the March 2020 sell-off, some BDCs dropped 40 to 50% even though their loan books were largely intact. You get liquidity, but you also get volatility that doesn't actually reflect what the underlying assets are doing. Door 2, interval funds. These don't trade on an exchange. Instead, they let you redeem your shares only at set intervals, typically once a quarter, and even then, they can cap redemptions at 5% of the fund's assets. That means if everyone wants out at once, you might only get a fraction of your money back each quarter. In exchange for that illiquidity, you get something closer to the true private credit experience. Smoother returns, less volatility, and yields that more accurately reflect the underlying loans. So here's the question that actually matters, and almost nobody frames it this way. How likely are you to need this money in the next 3 to 5 years? If the answer is not very, you're building a long-term income sleeve in a retirement account, you have other liquid assets you can tap, then an interval fund's illiquidity isn't really a cost. It's just a feature you don't care about. And in that case, you're getting paid a meaningful premium for accepting a constraint that doesn't actually constrain you. If the answer is possibly, this is money you might need for a house, a career change, a family situation, then a BDC gives you the exit ramp, but you need to be prepared for the fact that the exit ramp might be at a bad price. You could need the money exactly when sentiment is worst and BDC prices are most depressed. The worst outcome, and it happens more than people admit, is buying an interval fund thinking it works like a bond fund, then hitting a redemption gate when you actually need the cash. One more thing worth naming directly: private credit borrowers are not investment-grade companies. These are typically smaller, leveraged businesses, the kind that, in a genuine economic downturn, are more likely to struggle with their debt payments. That's why the yield is higher. It's not a free lunch. The extra 3 to 6 percentage points over investment-grade bonds exist because the underlying loans carry more default risk, and because you're accepting less transparency into what you actually own. That doesn't mean avoid it. It means size it accordingly. Most thoughtful allocations treat private credit as a slice of the fixed income portion of a portfolio, not a replacement for it, and not a return-free substitute for cash. So, does private credit belong in your portfolio? Probably yes. If you have a long time horizon, you already have liquid assets elsewhere, and you're looking for income that genuinely outpaces what investment-grade bonds are offering right now. The vehicle matters more than most people realize. BDCs if you want liquidity and can stomach price swings. Interval funds if you want smoother returns and won't need the money for years, and only after you've read the redemption terms carefully. The yield is real. The illiquidity is real. The only question is which one of those you can actually live with.